Hi, everyone. Welcome back to EdgeBytes, where we strive for signal over noise in the global enterprise AI economy. My name is Mark Vigoroso, founder and CEO here at the Enterprise Edge. Let's call today's episode AI Monetization, SaaS Panic, and what Salesforce and Workday just proved. So over the past few months, you've probably seen the headlines. You've heard SaaS is dead, growth is over, AI will commoditize software, enterprise platforms are peaking, and the like. So market volatility certainly hasn't helped. The multiples have compressed. Some big names have stumbled. The narratives have turned melodramatic. But this week, two earnings reports quietly poured cold water on all that panic. Salesforce and Workday just reported fiscal 2026 fourth quarter and full year results. And if you read them carefully, they tell a much more disciplined and nuanced story about where SaaS actually stands. So let's start with Salesforce. They closed fiscal 2026 at $41.5 billion in revenue, up 10% year over year. Fourth quarter revenue reached $11.2 billion. Remaining performance obligation, contracted future revenue or backlog now stands at $72.4 billion, up 14%. That is not a dying demand curve. That is durable enterprise commitment. Operating cash flow hit $15 billion, up 15%. Free cash flow up 16%. And they authorized a new $50 billion share repurchase program. That's not defensive posture. That's capital strength. So now let's look at Workday. Fiscal year revenue came in at $9.55 billion, up 13%. Q4 revenue was $2.53 billion, up 14.5%. Subscription revenue grew nearly 16% in the quarter. Operating margin expanded materially, and operating cash flow reached $2.9 billion, up almost 20%. So let's address the panic directly. If SaaS were dead, you would see slowing bookings, shrinking backlog, margin compression, and cash flow stress. So what you're seeing is basically the opposite. What is dead, or at least evolving, is undisciplined SaaS growth at any cost. The era of grow fast and fix margin later is over. The new SaaS model is durable, cash generative, AI augmented platform infrastructure. That's a very different narrative. So here's the strategic pivot inside these earnings that matters even more. Salesforce isn't just reporting ARR anymore. They're reporting 2.4 billion agentic work units delivered, nearly 20 trillion tokens processed. That language shift is intentional. They are reframing SaaS from software licenses to measurable labor execution, work performed, tasks completed, enterprise throughput created. That's not SaaS dying. That's SaaS evolving into digital labor infrastructure. Workday is doing the same thing inside HR and finance, embedding AI directly into workforce planning, financial close, compliance workflows. But importantly, they're pairing AI with margin discipline and predictable subscription revenue. So what does this mean for you? If you're a CEO, this should calm the panic, but sharpen your expectations. Enterprise SaaS isn't collapsing. It's consolidating around platforms that embed AI directly into operational systems of record or systems of action. Your question shouldn't be, is SaaS safe? Your question should be, are we extracting measurable productivity from the SaaS platforms we already pay for? If you're not quantifying throughput, cycle time compression, or revenue acceleration from embedded AI, you're under leveraging your stack. For CIOs, this is an architectural inflection point. The vendors winning right now are those integrating AI natively into core workflow, not bolting it on as an accessory. That reduces integration risk, but it increases platform concentration risk. So your discipline also must increase. Standardize where it makes sense, but preserve data portability and governance, and avoid AI sprawl disguised as innovation. For CFOs, this is where the SaaS is dead narrative really falls apart. Both companies emphasized operating margin expansion and cash flow growth. This is SaaS maturing into infrastructure-grade capital efficiency, subscription predictability, plus AI-driven productivity, plus cash generation. That's not fragility, that's resilience. But here's the caution. While the platform leaders look strong, the middle tier of undifferentiated SaaS providers may feel pressure. AI compresses feature differentiation. Customers consolidate vendors. Boards demand ROI clarity. So the panic shouldn't be about SaaS broadly. It should be more narrowly about mediocre SaaS. The winners are becoming AI operating systems for enterprise workflows. The laggards are becoming replaceable utilities. That's the real separation that's happening. And it's accelerating. Salesforce is guiding towards 63 billion in revenue by fiscal 2030. That is not a company bracing for contraction. Workday continues double-digit growth with expanding profitability. These are signals that enterprise buyers are not abandoning SaaS. They're demanding more from it. Measurable automation, embedded intelligence, financial discipline. We've moved from experimentation to accountability. The SaaS panic makes for dramatic headlines, sure, but the earnings data says something much simpler. SaaS isn't dead. It's growing up. And AI is not killing it. AI is redefining what enterprise software must deliver to justify its place on the balance sheet. That's the real story inside these numbers, and that's your edge. I'll see you next time on EdgeBytes, where you get signal over noise. Thanks, everybody.